Hello and welcome to another educational video brought to you by Bayntree Wealth Advisors. You may have seen the first part of this video, which is Interest Rates 101. And if you haven't, I would recommend checking out that video first, since this video will be diving a little bit deeper into interest rates and inflation, how they're related, and how it relates to the stock market. First, a general disclosure. This video was made for educational purposes only and should not be seen as specific investment advice. As I mentioned, this video is going to be about interest rates and taking a look at how it is related to inflation in addition to the stock market. So this is, in theory, how interest rates and inflation should work. So if interest rates were to increase, that typically causes inflation to decrease because we have less money circulating in the economic markets. And that also causes borrowing from lenders to become more expensive because interest rates are going up, and demand for goods and services typically decreases because people aren't willing to pay as much. Reversely, if interest rates were to decrease, that typically causes inflation to increase, really because of the inverse of all of the first reasons that I mentioned when they increase. So money in circulation when interest rates decrease would increase the amount of money that's being circulated, which means people have more money to spend, which means demand goes up, which means prices go up. Hence why inflation increases. Now, if we look specifically at inflation, if inflation increases, then typically the Federal Reserve wants to decrease interest rates. So again, the money in circulation would increase if there is inflation. So that is why they would want to raise interest rates so they can decrease that monetary supply. And then borrowing would become cheaper in a period of inflation, hypothetically, because interest rates would need to be cut. In addition, if there is more money in circulation, as I mentioned, that causes demand to increase and therefore prices to increase. And inversely, if inflation were to decrease, then we would potentially start to see interest rate increases because it means that we have room to increase those interest rates. And then that would essentially cause the money in circulation to decrease, again, because the cost of borrowing becomes more expensive. And therefore, if there's less money in circulation, then less money for people to buy things, which means demand and prices go down. So you'll see that they're all in a way kind of related, and they definitely are intertwined. You'll see here the blue line on the graph represents the inflation rate, and the black line represents the Federal Reserve's interest rate. You'll see, during the period of in 2020 to 2021, we were in a low interest rate environment. That is why the black line is very close to the bottom. And because of that low interest rate, which means there was a lot of money in circulation, a lot of demand, and then that caused inflation, which is the blue line. And you'll see once there was a peak in the blue line, you'll see how the Federal Reserve started to raise those interest rates, and that did cause inflation to start to decrease. So it did actually work as the theory suggests. And how interest rates are related to the stock market, this is typically an inverse relationship, meaning they move in opposite directions. So therefore, when interest rates are low, stocks tend to perform better. And when interest rates are high, the stock market tends to not do as well. I hope you found this video educational and valuable, and check in for more videos. Have a great day.